Good morning, everyone. My name is Jonathan Levin. I'm a columnist with Bloomberg Opinion. I'm here with Nir Kaysar, Bloomberg Opinion columnist covering markets and the founder of Unison Advisors. Also here with us today, my colleague Allison Schrager, Bloomberg Opinion columnist and author of An Economist Walks into a Brothel and Other Unexpected Places to Understand Risk. The theme of the day is CPI. The street's expectation is that this number is going to come in at a plus 0.3% seasonally adjusted. That would be versus a prior 0.1%. Core is expected to come in at 0.3% as well. And that would translate into a CPI of plus 2.6% year on year. That would look like a little bit of an acceleration, but I wouldn't read too much into that because that would basically be what we in the biz call base effects. But we're going to see. The big question here is whether or not we'll start to see tariff pass through in a more meaningful way here. It's been hard to come by in these recent reports, but in fairness, economists have generally thought that this would be a summer affair. Some folks are saying that it'll be more of a July-August affair, but you'd really expect to start seeing something here in June. So we'll be looking closely at household furnishings, recreation commodities, personal care products, education and communication commodities, all these sorts of things for any kinds of hints. So Allison Schrager, over to you. How should we be reading and thinking about this report, you think?
I'm trying not to read too much into it. I mean, every report is special. I don't want to minimize it. But, I think we keep expecting this very dramatic impact from tariffs because, we're told they're awful. I believe they're awful. And we kept expecting something to happen and it's not happening. And I mean, in some ways it's because, as economists, we haven't really seen, or any of us, we haven't seen like significant tariffs since like the 30s. So I think how they're going to impact the economy, we know it's going to be a big deal, but we keep expecting it to show up. And so I'm starting to suspect that the way tariffs are going to harm the economy might not be so dramatic. It might be more subtle. It sort of erodes your competitive nature. It sort of, shows up slowly. So I'm trying to temper my expectations that, we might see some movement in inflation, but I'm not expecting too much.
Okay, Nir, what do you think about that? From an investor standpoint, how should folks be thinking about where we are with tariffs right now?
Yeah, I've been guided by two broad principles. One is try to keep an open mind because, I don't really know how all this is going to play out. And the second principle is the best guesser is likely to be the market. So, trust the market's not perfect, but trust the market more than any individual guess. And so, I look at a few metrics just to see what the market is thinking around all this stuff. One is the 2-year Treasury yield. I think that's predictive of, or the best predictor of where the Fed's going to go. It's been hanging around 3.75 to 4 range for a long time, meaning, it thinks the Fed has 1 or 2 cuts ahead of it. Mm-hmm. That tells me, obviously, if the market were expecting tariffs to kick up inflation, it would not be pricing in rate cuts. So that tells me that the market is not expecting a ton of inflation from tariffs. Also keep an eye on interest rates in general, just to see like what is the term premium, what are the credit premiums, is the market bullish? When you look around now, I mean, amid all this uncertainty, the market is showing a lot of stability. Credit spreads are tight, term spreads are tight. So I would be guided by that at the moment. Having said that, I'm as excited as anyone to see what comes down the pike in July and August. I mean, I don't know that I've been this excited in a long time. So it'll be interesting to see what happens in the next couple of months, because I'll tell you, if a lot of the observers are right that there is trouble coming, the market is going to turn out, the market will be embarrassingly wrong. Let's put it that way.
Yeah, well, heading into this number, we had the yield on those 2-year Treasury notes up just about 2 basis points, right? So anticipating that. And of course, the stock market has been hovering around all-time highs for some time. So taking this in stride, there is, of course, this other possibility that tariffs could play out through profit margins primarily and not necessarily through consumer prices. We have the numbers populating here now. So it ends up CPI month on month, 0.3%. That was in line with consensus. But your core comes in a little bit softer at a 0.2%. That ends up translating into this is your headline. This is a little bit funky. Your headline ends up being year on year a little bit above consensus, 2.7%. We have some rounding issues here, I suspect. And CPI ex food and energy, that's your core number. The year on year number ends up being bang on. So as I say, this looks like the sort of number where you have to take it out to several decimal points because the consensus was bang on in some respects. It's a little bit softer on that all-important month-on-month core number. But all told, in the main numbers here, no very negative surprises. Let me take you over real quickly to some market reaction real quickly, just so you can see what's going on with the 2-year Treasury note. So you do see that dropping. That's sort of the knee-jerk reaction. We have a 3.89% on your 2-year Treasury note. Again, that's just the knee-jerk as we see this risk event sort of passing. Nir, we're going to have a second in just a moment to look under the hood here, but does that feel right to you, this immediate relief in markets?
Yeah, I mean, that seems about right. I mean, I think, one of the things that I look at is the sort of the break evens. I like the 5-year break even because it's a pretty robust market. Comparing the 5-year treasuries, the nominal and inflation protected. And it's been hovering around 2.5% for a long time. And that, this comes in roughly around there. So, I think the market has been pretty good so far on that number. I think the trickier thing is going to be, that's frustratingly, if I'm the Fed, frustratingly still higher than my 2% target. And so then the question is going to be what to do about that. And I think that's where the market probably is a little bit confused, as am I, as I think is everybody. Is the Fed going to insist on the 2% target, or is it going to allow for a 50, whatever it is, 20 to 50 basis point float above the 2%? Is it going to be flexible? Because, I don't know with these headwinds, I don't know how close they can come to the 2%. But, if you told people 2 or 3 months ago that you were going to get 2.5% reliably, and I don't know that that's where we're going to be, but let's assume that's where we're going to be for a second. If you told people that, I think everyone would be relieved. And so, relief from the market sounds about right to me.
All right. Allison, what do you think this means for the Fed? And then we'll get right into the decomposition here, because I know we want to talk about tariffs. What do you think this means for the Fed, first blush?
I think it's getting really hard to justify the cuts the market is expecting. I mean, this isn't a bad report. I wouldn't say it's a great report, but a lot of this increase is coming, the price increase is coming from services. I mean, there's some increase in apparel. I don't want to jump the gun on breaking this down, but I think Nir's right. And I was saying this even before tariffs, that we might just be at a higher equilibrium rate of inflation than we were pre-pandemic. They're going to be doing their review in the fall. Maybe they're going to have to rethink their target. But it's hard to say that this is an economy where rates are having a dampening effect. And it's also hard to say that we're seeing a big impact from tariffs. I mean, we're seeing a little bit from apparel tick up, but nothing outrageous. So it's just... This economy, I just don't get it. It just seems impervious to policy. We're doing some outrageous policies, rates should be restrictive, tariffs should be freaking everyone out, and it's just it's sort of just kind of good, which I guess is important, which is what we should be happy about, because that's good for America. But as an economist, I'm kind of disappointed.
It's an amazing machine, the U.S. economy, and it's almost like a Mr. Magoo situation. You can do so much stuff to this economy and this market. And at least up until this moment, knock on wood, we're still sort of logging incredible numbers on the S&P 500. Unemployment is still low. GDP is still cooking, generally speaking. We think with a little hiccup in there in the first quarter. Let's talk about the decomposition here real quick. So what we have here is the decomposition of the contribution of month on month headline CPI. So let me take you through that. So big picture, a few things to bear in mind. As Allison says, the yellow bar up on your screen is core services. And we're still in an economy where core services is where most of the inflation is coming from. Now that's normal to a certain extent. That was the situation like prior to the pandemic and prior to all of this craziness starting. But to the extent that you want to blame anything for sticky inflation, it's still core services doing a lot of the work. So what's going on in core services? So the contribution from shelter, not actually too bad. Stepping down, we do see medical care services stepping up. I'm always, curious and scratching my head about that one because that's one that's measured differently in the PCE, which is the Fed's preferred measure. So to the extent that medical care services in the CPI is the problem, sometimes it ends up not being that big of a problem, like a day later when we get the PPI. So we'll just take a breather on that one for the moment. Transportation services, nothing too much to see here. That pressure in transportation services, by the way, had often been coming from things like auto insurance, and that's been cooling off in the market data. So that could help us going forward. That's that. It's not a terrible number from core services, but it's not giving us all the relief that we would like to see. Now let's get into core goods, because this is where you're going to see those tariff impacts, if at all. So transportation commodities, that's like your cars and stuff, deflationary in the month of June. This is seasonally adjusted again, but what's going on? You have new vehicles falling. This was somewhat expected. Like, this isn't actually like price cuts on dealer lots. What happens is, like, you see more of these incentives, and that flows through into the CPI. Used cars and trucks, this is falling. This was somewhat anticipated based on auction data. I just want to pause and say I have this sort of thesis that, like, in the core goods category, cars are so dominant. They're so dominant. And there is a sense that just because of their dominance, like, as go cars, so will go the tariff inflation narrative, So I think you really have to watch what's going on those dealer lots in the months to come. And it's tricky. I'm not saying that a lot of these companies aren't hurting, but they also know that consumers are a little apprehensive out there about buying autos. So it could be a tricky calculus for those cars and trucks. Now, household furnishings, we do see a fairly meaningful contribution here. Let me actually take you into the decomposition here so you can actually see what I'm talking about. I apologize for not taking you along with me. Household furnishings is in your orange bar up here. At the very top of the column. I want to point out that this isn't like a heavily weighted category. So, like, if cars and trucks are behaving themselves, it's going to be hard for household furnishings to really move the needle in overall inflation. But we do see a meaningful contribution coming from household household furnishings. And that's interesting to me because there's like a lot of softness in the housing space. We also see, Allison called this out straight off the bat. We saw a step up in the contribution from apparel, a step up in the contribution from recreation commodities. And just to make this a little bit more, palpable, understandable, let me get out of this like weighted contribution thing and tell you what's actually going on with these things. So what this all means is household furnishings plus 1% month on month rounded, apparel plus 0.4% month on month sort of rounded. And the other big one is recreation commodities plus 0.8%, rounded. I would say, meaningful move, like statistically significant move in household furnishings, statistically significant surprise in recreation commodities. Everything else, I'm kind of like, I don't know. So we're starting to see it. Like, I don't think people were wrong. Tariffs are affecting the price level. Are they going to affect inflation, though, in a meaningful way? Like, that's the big question. That's where the rubber hits the road. Like, is a 1% move in household furnishings from May to June going to affect people's inflation expectations, Allison Schrager, in a way that makes this a more enduring problem? Or are you not convinced of that at this stage?
I mean, probably not, because as you point out, I mean, this isn't a big part of the consumer's basket.
Mm-hmm.
And, it also, like, I hate to say it, isn't gonna impact their welfare that much. I mean, when you have to buy new furniture, it's bad that it costs more and it's going to take longer to get. That will make people happy. But how often do you buy furniture?
Right.
No, and also, I mean, as Nir pointed out, it might start to show up more in corporate profits, which also, like, companies might eat some of this cost, which, also, I don't want to minimize, because that would effectively means is you have bigger companies with more profit margins dominating markets more, and smaller businesses that rely on imports, might not be able to survive. But you know what? Like, again, for a consumer's daily experience, that might not make a big difference. That might not show up in inflation. But depending on, how what you want the economy to be, I mean, that's not nothing. But and maybe that's soft data, not hard data. I'm not sure. But this is like a big economic experiment. And, how this is playing out in data, I said, we're finding out in real time. We haven't done this in a really long time. The economy was really different in the 30s. Trading relationships are different. So I don't know if we can be like, declare this month that, tariffs don't impact inflation. I don't think I'm ready to go there. But it might play out in ways that are unexpected.
Sure. Nir, can I put you on the spot for a sec too?
Sure.
Let's play some three-dimensional political chess here. There's this whole conversation about taco. Trump always chickens out. Great phrase from our colleague Rob Armstrong over at the FT. A question I have when I see a report like this is, does President Trump see it and assume he can just go further with his policies? Like does a sort of innocuous report like this? I know we're kind of iffy about maybe innocuous, but it's not terrible, right? Does a not terrible report like this embolden him to just keep going with these things? I mean, we're in the process of rolling out new threats, like just in the past 7 days. So do you worry about that sort of thing, the feedback mechanism between policy and markets and the reports themselves, of course?
Yeah, I mean, I think the sell-off. There is a danger of putting too much in this interpretation. So let me put a pin in that, But it seems to me that the lesson we learned in the spring when we got that market sell-off, and it seemed to me that the administration was backing off a bit, says to me that they're watching the markets and they're sensitive to market signals. And so I think they're doing two things. I think they are watching the market to see what the market thinks. And then I think they're watching the data come in to see to what extent that data is changing market expectations. And then I think they're saying to themselves, okay, this is the grand experiment that we want to try, leaving aside the merits of it for 1 minute. How far can we push this thing without breaking things that are important to us? And it seems to me that the markets are important to them. I don't know how to read the sort of the reaction to the market sell-off back in the spring. So I do think they're going to push as hard as they can push without breaking things that are important to them. And in that regard, I do think that they're watching the market carefully. I think that these kinds of results, to the extent that they're in line with market expectations, are going to embolden them. And they'll just keep pursuing the agenda until someone pushes back. That's someone, I think, being Mr. Market.
Yeah. Allison, Chair Powell over at the Fed has been getting a lot of criticism from the White House recently. But doesn't a report like this really just show that Powell has the story exactly right? I mean, if you heard him at the last few press conferences, he's basically been saying, I want to see how the data come in over the summer. And I think implicitly, he's left the door open to a move in September. There's some amount of pricing that is going to happen in the market. But Powell has basically been implying, let's see how this June report comes in. Let's see how July comes in. And let's see how August comes in. I think they're going to get the August CPI report like a few days before they actually do their September decision, which I believe is on the 17th. So he must feel kind of vindicated by a mixed report like this. Doesn't a report like this just say, yeah, let's keep watching the data for another 2 months?
Yeah, I think he was always pretty confident. I mean, he never really took an outrageous position. I mean, he's a careful guy. I think there's something contradictory about Trump's view, which on the one hand, this is a fantastic economy and all of his policies are having nothing but a great effect. If that's the case, why do we need to cut rates? He keeps saying it's outrageous that interest rates are as high they are, but it's like, well, what damage is that causing? You need to cut rates if you need to boost the economy, unless you want to argue the alternative, which is, well, we need to cut rates because rates are still restrictive based on the last fight of inflation, which is over. So I don't see rates being restrictive. I also don't see any damage to the economy. So what's the argument to cut rates at all? And I think Powell has felt pretty grounded and confident in that. I also I don't think he really buys that Trump is going to fire him. I mean, why would he fire him when he's, his term's up in 9 months?
Right. May.
Yeah, May. Why bother sort of throwing this huge wrench in the whole concept of Fed independence, which I think Trump knows isn't healthy, just to get a rate cut 9 months earlier, and a rate cut that probably is not honestly going to make a big difference. I think Bill Dudley just wrote a column I wish I wrote, pointing out that, you can cut rates on the short end. That's not going to do anything for consumers on the long end anyway. In fact, it might make it worse.
Right.
So, I think, Jay Powell can feel pretty good. And if I were him, I wouldn't even be that worried about losing my job in the next 10 months. After that, it's a different story. But at least for the next 10 months, I think he's feeling good.
Right. Right. So Near, in this environment, what matters for stock market investors? Because, we're in this wait and see with the Fed. The bond market is telling us today that outlook hasn't really changed very, very much. We're coming out of this report basically where we went into it on the 2-year Treasury note. Tariffs, the stock market's reaction to tariffs has so far surprised many of the bears. The resilience, what matters here? Is it the earnings season that we're seeing starting to play out with banks this week, or where do we take signal from as stock market watchers?
Yeah, I mean, this is a bit wonky, but I think it's super interesting. Is that, if you look at, first of all, at a high level, I mean, all we've done is we've done an undo of the year, right? If you look at the market, it's roughly where it was before all this tariff hullabaloo started. So it's not so much that the market is up; it's just that the market has recovered ground that it lost and is just waiting to see. But here's the wonky part. What's interesting is that, I looked at Bloomberg compiles for every company, for every public company. It compiles all the analysts' outlook for earnings, and it calculates the variability of those forecasts. In other words, sometimes analysts, and for big companies, you can have a lot of analyst estimates. I mean, you can have 40, 50, 60 estimates for some of the bigger companies. Sometimes those estimates are very close together. In other words, there's large agreement about where earnings are going to come in. And sometimes you see a divergence in opinions. And right now, you're seeing a broadening of disagreement among analysts. And you can see that in the standard deviation numbers. And this is my plug for the terminal. If you're a terminal subscriber, you can look at the standard deviations in the analyst estimates for each company, and you can see how they've changed. And you can also look at the high-low and see that that's broadening out. And so what I would say is, even though on the surface the market looks like it's in decent shape, I think what I would say is the market is sort of in a wait-and-see mode. And what it's waiting to see is who's right about the underlying earnings projections. And right now, I think the thing to be most cognizant of is that there is growing disagreement among analysts about where earnings is going, And I think that that's an indication of the uncertainty that's out there and why you're not really seeing a lot of direction from the market after it found its legs and effectively, brought back a lot of those declines that it had earlier in the spring. So that's what I would watch. I would watch not only where the earnings are coming in, but because, ultimately the market's forward looking, I would watch whether the disagreement among analysts is growing or whether consensus is forming. Because as long as that disagreement is growing, I think that's an early indication that uncertainty is getting worse, not better. And that's ultimately not a good place for the market to be.
Yeah, but it is interesting. Like another place that uncertainty should rear its head is like in multiples, right? I mean, classically, if you're in an uncertain environment, you should apply a higher risk premium. But it doesn't seem like we're seeing that in the multiple that market participants, not necessarily the sell side analysts, but the market participants themselves are applying to the market here. How do you square that, Nir?
Yeah, I mean, I think you really have to parse it out. It depends where you look. And what makes it tricky is you have these sort of like cyclical, currents running into secular currents. And what I mean by that is, if you look at what's happened to the U.S. stock market over the last 20, even maybe 30 years, what you see is that there's been a big a divide in profitability. The big companies, the mega caps, are hugely profitable. And if you go down the market cap spectrum to the mids and then into the smalls, you see that profitability really falls off a cliff, or at least it has. And if you look at the divergence right now in large versus small profitability, and how profitable these companies are, you'd see a huge divergence between, say, the Mag 7, I'll take extremes, the Mag 7 on the one hand, the Russell 2000 on the other hand. So there's that. And ultimately, profitability and valuation are very closely linked. And ultimately, you're going to expect to pay more for companies that are more highly profitable. I think the resilience in the broad indexes, which are heavily weighted to the larger stocks, obviously, the resilience there, you're seeing, I think, something that's more secular. You're seeing the resilience of the underlying profitability. The question is, what do current, let's say, the current headwinds, how do those inform that the sort of structure that I've just outlined? And this, I think, what Allison pointed out earlier is really important and interesting to keep an eye on, which is the divide between the large companies and the small companies. She had mentioned small businesses, and that's definitely right. But some of that could also apply to the very small companies in the U.S. stock market. How does all of this apply to their profitability? I mean, could it be that ultimately tariffs have an asymmetrical impact on the market, where the big companies get stronger and more profitable and the smaller companies get weaker and less profitable. And if that's the case, what you're going to see is broad market indexes that are very resilient on the valuations, and a lot of people scratching their head about why that is the case. But the reason that's the case is ultimately the margins and the profitability. And you touched on margins earlier, Jonathan. I mean, there's a separate discussion here about what happens to margin.
Yeah, 100%. Well, just a quick market update as we try and take this home here. So we do have the 2-year Treasury note, the yield on that down now ever so slightly on the on the day on the back of this. But let's call it unch, basically. Some wiggles. We have moved down from some of the jitters heading into the number, but not super statistically meaningful here. Allison, a question I have for you here is, of course, there is this big question about who Trump is going to pick for the next Fed chair. And we have a bit of a beauty contest going on there. Everybody who's in the running seems to know that they are in the running. We have Hassett, who's part of the Trump administration. People speculate that Secretary Bessent might be part of the process. He was asked about that on Bloomberg television this morning, and he artfully avoided the question. People talk about Governor Christopher Waller. I did a column about why I think he's the best pick of the field, but you can see ever so subtly all of these people sort of trying to ingratiate themselves with the president by saying the right things about the economic environment and leaving the door open to rate cuts and so forth. So my question to you, Allison, the last question for the day, if you were in the running for Fed chair, how would you spin this CPI report today?
Well, what I think would be right thing to say as Fed chair, it would get me the job.
Well, yes, no, certainly the latter. How would you spin it if you're hoping that President Trump sees you on Fox Business and says, that's who I want in the seat?
I would say this economy is an abomination, that interest rates are holding back. And it looks good, but it could be even better if only rates were 300 basis points lower. All
right. Nailed it. Okay. On that note, from our future Fed chair, that is a wrap from us. My name is Jonathan Levin. I'm a columnist with Bloomberg Opinion. Thank you to Nir Kesar and Allison Schrager, and we will see you all on the next one. Thanks again.